Michael Burry predicted a bullwhip effect, which was exactly what we're starting to see now in the markets. But in the retail space, I think it's starting to open up some very interesting opportunities, and that's what we're going to cover in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into this one. So it's a very interesting time right now, because I actually released a video recently where I covered Michael Burry's tweet where he predicted what's called a bullwhip effect. If you haven't seen that video, I will link to it at the end of this video. But it's a very interesting concept, because essentially what he's saying is that the inventory buildup has been very excessive, and there could be a situation where inventory values go up and down based on sort of like small measures of increased demand. And so I dive more into it in that video, but effectively we're starting to really see that. And where we're seeing that right now is from the perspective of retailers who have an excess amount of inventory because they ordered an excess amount of inventory to sort of address the supply chain issues in an environment where retail purchasing was hot. Well, we're now getting into an environment where retail purchasing is not so hot. And so, of course, there's going to be sales and write-downs, et cetera, to get this inventory out the door. And, you know, we've already seen companies like Walmart and Target come out and try to get ahead of that. And so we're seeing other opportunities. And so, of course, what's happening as a result of this is that you're seeing me talk more and more about buying retailers in an environment where people would be like, hey, you probably should stay away from retailers. Well, here's a secret about value investing. Generally, when everybody thinks an industry is not a good industry to invest in, it's typically reflected already in the valuations. So for example, the home builders year to date are down over 30%, and so is the retailer index. And so the question becomes, where are the opportunities? Of course there's retailers down that probably should be down. Of course there's home builders down that are down that probably should be down. But where's the opportunity of the strong retailer that's been oversold? And that's kind of what I want to cover here. So let's dive right into it. So you can see here, this Wall Street Journal article said that the excess inventory amounts are piling up at large retailers such as Target and Walmart. Now, these were the guys that really came ahead of it. And so what exactly is this article saying? There's a glut of kitchen appliances, televisions, outdoor furniture, and apparel. In many cases, the liquidators are picking up pallets of this inventory from the warehouses without it ever even hitting the shelves of these retailers. That's how much excess inventory is in the books of Walmart and Target and other types of retailers like this. They're effectively asking the liquidators to get in front of this way earlier than in the past. And why is this happening? Well, the article does describe that because of the supply chain bottlenecks, these retailers tried to get ahead of this issue by ordering more inventory to address the fact that the inventory was coming in slower. And so now, with the consumer slowing a little bit, you're starting to face this situation where you have a glut of inventory. And the other thing is, you're getting inventory later than the season at which you would want to sell it. So for example, I think sweaters came in a little bit later, like winter goods. I think those came in a little bit later in 2021, and so you can't sell them now. Well, we're in the summer season now, so you're probably gonna have to wait another quarter before you can start selling those, or you could have liquidated them early, which is what they tried to do. And you can see here that the mismatch between supply and demand has left large chains like Target, Walmart, Gap, and Macy's with excess goods that they need to clear out. And effectively what individuals in the industry are saying is that there's more excess merchandise now than there has ever been in the past 20 years. But my question is, are there some retailers that could potentially be benefiting from this excess inventory? Well, I think there's two retailers that can really benefit from there. And the main one that I really like, and it's a company that I bought way back, like 10 years ago, is Ross Stores, because they generally purchase sort of the tail end, the unwanted stuff from manufacturers, and they sell it in their stores for much cheaper than what you would buy it at the other retailers. And so now you're getting just this higher quality inventory that's getting very heavily discounted, which I think is a good thing for Ross. And so the question is, what does the share price for Ross Stores represent right now? In other words, is this stock cheap or expensive? And you can see that at $71 per share, Ross Stores has a very strong PEG ratio. So that's price to earnings growth. And for those of you who are not familiar with that, that's something that was made popular by Peter Lynch. So really look into it, but I would highly recommend you even reading Peter Lynch's books if you haven't. And if you want to join the Patreon, we actually are starting a book club where we're going to cover a book every couple of months. And so we'll read around 6 books a year and cover them. So that's something in addition to the offerings that we already provide with the Patreon. And so if you're interested in the book club, please join us. But you can see that the PE gap on a trailing 12 months basis reflects 16 times earnings. So it's not cheap. And the forward PE gap represents around 16 times earnings as well. So once again, it's not cheap on a PE ratio, but it is somewhat cheap on a PEG ratio. Now, the only other thing that I do want to show you guys is sometimes the PE ratio doesn't necessarily reflect the whole story. On their balance sheet, you can see that they have $2 billion of excess capital. So when you're valuing the stock, you're going to have to account for that and just sort of build that into your calculation. Like I do for all of my evaluations, you always see that I throw in the excess cash. And what are they doing with that excess cash? Well, you can see here that they're buying back shares. In the first quarter, they used $280 million to buy back shares. And sort of what direction are they going in the future? Well, they're continuing on with their newly approved stock repurchase program where they're expecting to repurchase up to $1.9 billion of the company stock through fiscal 2023. And so that obviously makes a lot of sense because that effectively represents the excess cash that they have on their balance sheet. And now from a more future valuation perspective, I kind of wanted to get an idea of what Ross Stores is valued at, not just in 2022, because in 2022 we're facing some headwinds, but also in 2023. And so you can see that based on 2023's earnings, they're trading at approximately 15 times earnings. So that's down 1 times from 16 times in 2022. And then based on 2024's earnings, they're trading at approximately 13 times earnings. Now, here's the question though, that a lot of people are concerned with retailers because they don't believe that those earnings estimates are realistic. They feel as though that E is going to come down and thus the valuations of these companies will continue to come down. And that's a very real worry. And so the way I'm thinking about that is I'm looking for very strong retailers like Ross, but even stronger from my perspective, like strong brands at least, that are trading at much cheaper. And I actually have a very interesting opportunity that I also have on the tracker. So Abercrombie & Fitch is actually down 50% on fears of a consumer slowdown, meaning that they potentially have excess inventories that they're going to have to discount significantly. So gone are the days where the stock is trading above $40 per share, which it was earlier in 2022. It's now trading at approximately 17, 18 bucks a share. But what does that actually reflect? It reflects essentially a valuation from my perspective of $60 per share, $57.70 per share. But within that valuation is broken up into 2 things. One, the company is worth approximately $50 per share at a terminal multiple of just 10 times earnings. So that's low, by the way. So you can easily throw that to 15 times earnings and have a valuation north of $70. You can easily do that. But the other more important thing is that $8.72 is effectively excess cash in the valuation. And so you have to add that in. But if the current share price is $17.59, effectively half of that current share price is just cash on the balance sheet. And it's not like management is forecasting weakness in this environment. Management has actually guided to $4.2 billion in revenues in fiscal year 2025. That's much higher than where they expect revenues to end in 2022. So they continue to expect strength into 2025. Now, here's the problem. Do you actually believe them? And do you actually believe that there will be strength into 2025? Well, I think there could be weakness in 2022 and 2023, but do we have weakness in 2024 and 2025? Maybe it could be a possibility, or it could potentially be an opportunity to buy the retailer now because we might not have that much weakness going forward. I'm not really sure, but I'll let the valuation take me to a buy or sell decision, and you'll see what I mean in the next couple of slides here. And what I mean is, check out the cash secured put analysis tool. So this is their January 19, 2024 long dated cash secured put. I know some of you guys don't like when I sell long dated cash secured puts because you guys like to wheel options, but I sell options to buy the security. So what I'm doing here is at the $15 exercise price, I can generate a premium of $3.50, which means that I can purchase this company for a net purchase price of $11.50. So what does that really reflect? It reflects an annualized yield of 15.3% or a 3.4 times forward PE ratio to their 2022 earnings. And effectively what that does is, remember that this company has $9 per share in excess cash. So if I'm able to buy Abercrombie & Fitch for $11.50 per share on a net purchase price basis, that means that for $11.50, I'm getting $9 per share of cash, and the whole company, all of Abercrombie & Fitch, is being sold to me for $2.50 a share. If somebody came to me tomorrow and said, hey, Tay, I'm going to give you all of Abercrombie & Fitch for $2 a share, $2.50 a share, I would absolutely buy it. So this is a no-brainer opportunity for me, which is also why it's the #1 opportunity on the tracker right now that the Patreons have access to. And if you want access to the tracker that the Patreons get access to, you can get access to all the models at the lower tier for the Patreons. And the other thing is, we have an epic live presentation every month where I reserve my absolute best work, research, and reasoning for those valuations, and I walk through the models at the higher tier for the Patreon. So that's just something interesting if you're interested in joining us every month for a live Zoom call where we go into all of the details. But like I always say, there's never any risk to you. I believe in the product so much that if you decide to try it out and you decide that it's not for you or you don't see value in it, don't just cancel. Message me in the Patreon and say, hey, Tay, it was not for me, and I will absolutely refund 100% of what you paid in that first month. That's how much I believe in the product. And here's the thing. I've been doing this for a year now. Not a single person has come back to me and said, hey, I don't see value in this, and so give me a refund. So it's never happened. And so that's real proof that there's real value here. Now, at the beginning of this video, I mentioned that Michael Burry predicted a bullwhip effect. And I actually made a video where I covered that. And you can actually get to that video right here.